Hi, and welcome to the Mortgage Expert. Today we're going to be speaking on how much home can I afford. This subject is going to be a little longer than usual because it's very important that you understand it. So grab a pen and a paper and let's teach yourself how to do this. The common question of how much home can I afford, like many things, is it depends. There's no concrete rules for how much you can afford or how big your monthly mortgage payment should be. The reasoning is simple. The way that a mortgage lender calculates your maximum purchase price will be different from the way you would calculate it yourself. Let's look at both approaches to home affordability. The first approach is using DTI. DTI is your debt to income ratio, otherwise known as DTI. This is your income as opposed to your debt. And this determines the maximum purchase price that a bank's going to lend you. So when a mortgage lender calculates a home buyer's maximum home purchase price, it doesn't actually consider the purchase price of the home. Rather, we look at the buyer's expected mortgage loan. That mortgage loan size and the current mortgage rates determine your expected monthly mortgage payment, which is very important because that's the number we use. So we compare that figure to the buyer's monthly income. Again, this comparison is known as the debt to income ratio. And this ratio, it has two components. We call it the front and the back ratio, or the front end ratio and the back end ratio. The first component of the debt to income ratio, the front end ratio, compares just the housing payment, okay? So your housing payment against your monthly income. So monthly housing payment, monthly income. This includes your monthly principal and interest payments on your mortgage. It includes your monthly real estate taxes that are due monthly. It includes your monthly homeowner's insurance. So take your annual divided by 12, and that's your monthly mortgage insurance, your homeowner's insurance. It also takes into account your monthly dues to any association. There's no maximum limit for this front-end ratio. However, lenders prefer to see the front-end DTI, or debt-to-income ratio, at 28% or less. In other words, no more than 28% of your monthly income, gross, should be allocated to housing payments. Now your debt-to-income back-end ratio, which is the key ratio in determining eligibility and which kills more deals than anything else. This back-end ratio not just compares your monthly housing payment against your monthly income, but all your monthly payments as seen by your credit report and your housing expense. So this back-end ratio, once again, it accounts for all of the following monthly obligations a home buyer may have. Your monthly housing payment, which is what we just spoke of, your monthly minimum credit card payments, any monthly child support or alimony you may have to pay, monthly car payments for a car loan or lease, monthly payments to any type of an installment loan, such as a timeshare, a student loan, or anything that's in installments that shows up on your credit report. In general, the banks want to see your back-end ratio at about 36% or less. However, having a DTI over 36% will not automatically disqualify your mortgage application. Many lenders allow up to 45% on a debt-to-income ratio. Some will go as high as 47%. With me, it's just the ability to repay the loan that I look at. Now, this is where I stand out in front of the crowd, because just because you should and you can get that amount of money to buy a house doesn't mean you should. When I sit down with new home seekers, we put a household budget together. And as a home buyer, you need to know how much you can afford and how much you want to afford monthly. In many cases, a bank will approve you for a bigger home loan than you may be otherwise comfortable paying. So if you have a DTI, let's just say debt to income ratio, in the back with all your expenses at 45% of your gross monthly income, and now that's spent right off the top, it doesn't leave much money for saving, investing, living, let alone paying taxes. If 45% plus 30% taxes, I mean, think about it. Therefore, another approach is how much home can I afford? Determine the maximum monthly payment you'd like to make every month towards your housing, whatever you can stretch to, and then work that figure backwards, and we'll find a maximum mortgage loan size that makes you comfortable with a monthly payment that doesn't change your life drastically. So for example, if you budget for a monthly housing payment of $2,500 and the current 30-year fixed rate is 4%, we take the taxes and insurance into account at about 2%. That's what it usually comes out to of the home. We work that math backwards. We find that our maximum purchase price for a payment of $2,500 a month is $385,000. So by setting your monthly maximum payment, you'll make sure to stay in your budget. If you leave it to the bank, you might just be stretching yourself too thin. It's very simple. Give me a call, 718-869-4795. We'll work out all the numbers for you. It's free, there's no obligation, and it's private. 718-869-4795. And thank you for watching The Mortgage Expert. Have a great day.